Plug Power stock is currently trading intraday at $3.35, marking a downward swing of 2.75% in today's active session, with a heavy trading volume of over 38 million shares changing hands as the market processes the latest macro pressures and sector-wide volatility. While the casual investor looks at this minor daily pullback and assumes it is just standard retail noise in the renewable energy sector, the real story developing behind the scenes is an institutional battle over the company's sudden margin shift. The expectation was that this company would continue its historical pattern of burning cash until it eventually faced terminal dilution or worse. But the reality is that the company just recorded a massive 42 percentage point improvement in gross margins, shrinking its losses from negative 55% down to negative 13%. This unexpected operational tightening has caught short sellers completely off guard, setting up a subtle conflict between the broader market narrative and actual corporate execution that could dictate the stock's path for the rest of the year. Most people looking at clean energy solutions tend to aggregate small-cap players into a single basket of speculative bets, heavily reliant on federal subsidies or high-risk capital raises. The common ground among retail traders using various online investing platforms is that this stock is a perennial underperformer that frequently overpromises and underdelivers. However, challenging that assumption reveals that the core underlying business is currently undergoing its most aggressive structural pivot since its inception, moving away from expensive third-party hydrogen sourcing toward internal production and highly profitable electrolyzer deployments. This shift completely alters how we must evaluate the company using modern self-investing frameworks, transforming it from a pure speculative vehicle into an industrial turnaround story that demands closer technical inspection. When you look at the recent trading activity, the daily swings tell a story of high institutional interest and rapid capital rotation. Over the past few weeks, trading volumes have surged well above the historical baseline, frequently exceeding 40 million shares a day as major funds recalibrate their positions after the first quarter earnings data dropped. This volatility is a playground for active traders using advanced online investment tools, especially those tracking institutional block orders on sophisticated setups like the Interactive Brokers platform. What they are seeing is a stock that has quietly rallied roughly 90% year-to-date, a staggering breakout that contrasts sharply with the broader market's choppy sideways consolidation. This massive accumulation phase suggests that smart money is looking past the immediate net losses and focusing instead on the dramatic reduction in per-unit service costs, which dropped by 30% in the latest quarter alone. This momentum is causing a serious headache for short sellers who have piled into the stock over the last few years. According to short interest data accessible through popular retail tools like the Robinhood app or via detailed technical screeners on the Fidelity trading platform, the bearish bets against this hydrogen pioneer remain exceptionally high. This creates a highly volatile technical setup where any incremental piece of positive news can trigger a violent short squeeze, forcing bears to panic and cover their positions by buying back shares in the open market, which only accelerates the upward trajectory. We saw a microcosm of this exact dynamic play out immediately after the recent earnings release, when better-than-expected revenue caused the stock to rocket over 14% in extended trading. For investors tracking active opportunities through a self-investing individual brokerage account, these explosive short-term moves highlight why this specific ticker has become one of the most heavily discussed names across major investing sites. Understanding the tension between market sentiment and real financial metrics requires looking closely at the first quarter performance metrics that dropped earlier this month. Wall Street consensus was bracing for a revenue figure around $142 million and an adjusted loss of 10 cents per share. Instead, the company delivered a massive top-line surprise, printing $163.5 million in revenue alongside an adjusted loss of just 8 cents per share. This top-line expansion represents a 22% year-over-year growth rate, a metric that outpaces almost every other competitor in the hydrogen space. The primary driver behind this revenue beat was a stunning 343% surge in their electrolyzer platform, which brought in over $40 million compared to less than $10 million in the same period last year. When retail traders log into their Robinhood investments or check their Fidelity Investments dashboards, these are the hard operational numbers that are forcing a total reevaluation of the company's long-term viability. Please comment below how many shares of Plug Power stock you currently hold in your portfolio and whether you are buying this recent dip. Despite these clear signs of operational recovery, the bears still have a valid thesis that prevents the stock from completely breaking free into a permanent bull market. The company utilized over $150 million in cash just to fund its day-to-day operating activities during the quarter, leaving its free cash flow deeply in the negative. This persistent cash burn is a metric that conservative asset managers tracking clean energy via Fidelity mutual funds or stable Fidelity ETFs look at with deep skepticism. When unrestricted cash drops to $223 million, it leaves an incredibly narrow margin for error, meaning the risk of secondary equity offerings and subsequent shareholder dilution is never truly off the table. Investors managing their wealth through formal channels like Fidelity Wealth Management or automated systems like Schwab Intelligent Portfolios generally lean away from such high burn profiles because a single operational delay can wipe out months of equity gains. The core question is whether the company can execute its asset monetization strategy to bridge the gap to the target of positive EBITDA by the final quarter of this year.
To fully grasp why this company is positioned where it is today, we have to look at its core business model and the structural foundation it spent years building. The company does not just sell hydrogen, it builds the entire ecosystem required to make hydrogen a functional industrial power source. Their primary commercial engine centers on manufacturing hydrogen fuel cells for material handling equipment, which are the heavy-duty forklifts and utility vehicles used inside massive high-volume warehouses and distribution hubs operated by global giants like Amazon and Walmart. Historically, the company would sell the fuel cell equipment and then guarantee a steady supply of liquid hydrogen to keep those fleets running. The structural flaw in that approach was that the company had to buy that hydrogen from third-party chemical suppliers at volatile market rates and sell it to customers at fixed contractual prices, leading to massive negative gross margins that consistently eroded their balance sheet. This brings us back to the current operational turnaround strategy, which is specifically designed to eliminate that structural vulnerability. By bringing their own domestic green hydrogen production facilities online and renegotiating legacy third-party agreements, they have managed to improve their hydrogen fuel margins by an astonishing 54 percentage points in a matter of months. This means that as massive retail partners enter new equipment refresh cycles over the next couple of years, the incremental revenue generated will actually flow toward the bottom line rather than being consumed by rising fuel procurement costs. For investors looking for investment help to diversify from detractor caps like Tesla stock, Apple stock, or Nvidia stock, understanding these microeconomic shifts within a specific industrial niche is critical to identifying under-the-radar value before the broader market catches on. Looking forward, the roadmap for the rest of the year is packed with critical milestones that will either validate this turnaround or send the stock back down toward its previous lows. Management has laid out clear guidance targeting full-year sales growth between 13 and 15%, with the second half of the year expected to generate roughly 60% of total annual revenue due to seasonal shipping cycles and project completion timelines. Key international deployments are currently in the commissioning phase, including a 25-megawatt project with British Petroleum and Iberia in Spain, alongside a massive 100-megawatt installation with Galp in Portugal. These represent some of the largest proton exchange membrane electrolyzer projects in all of Europe, and their successful integration will serve as a massive proof of concept for global utility providers watching from the sidelines. However, executing large-scale international infrastructure projects is notoriously complex, and any unexpected regulatory hurdles or supply chain bottlenecks could quickly stall this momentum. Investors monitoring these developments through their choice of investing sites or specialized individual brokerage setups must weigh these massive international opportunities against the immediate reality of high capital expenditures. If the company successfully hits its goal of a positive EBIT run rate by the fourth quarter, it will completely rewrite the investment narrative, moving the company out of the speculative tier and into the camp of self-sustaining clean energy providers. For anyone managing their own capital through a moderate slide is that the company is currently caught in a sharp transition zone where expectations are lagging behind a rapidly improving operational reality. For years, the market viewed this stock as a cash-burning vehicle destined for constant dilution, a view that kept short interest exceptionally high and depressed the equity value. The reality revealed in recent financial statements shows a business that is methodically engineering its way out of bankruptcy risk through strict cost discipline, internal fuel production, and massive international equipment backlogs. While the ongoing cash burn and the threat of dilution remain significant headwinds that require careful risk management, the structural improvements in gross margins suggest that the underlying business model is becoming fundamentally viable for the first time. Whether you analyze this through the lens of automated wealth management tools like a SoFi robo-advisor, execute trades manually on a Robinhood stock trading setup, or hold long-term positions inside your Fidelity IRAs, the structural divergence between what the market expects and what the numbers show creates a highly compelling setup. The easy narrative of a failing clean energy stock is breaking down, replaced by a complex, high-stakes turnaround that will heavily reward those who track the operational metrics rather than the speculative noise. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Share with your friends. Subscribe for more updates.